Hi folks, Ryan Honeyman here from Lift Economy. Many folks have come to us over the last 10 years and asked, how do I get more involved in creating an economy that works for the benefit of all life? They also ask, what skills and experiences do I need to help make this transition? So 3 years ago, we created something called the Next Economy MBA to help address this and similar questions. Lift Economy's Next Economy MBA is an online course that's designed for entrepreneurs, aspiring entrepreneurs, students, recent graduates, employees, and folks who want to learn more about transformational Next Economy strategies and businesses. Join the growing alumni network of nearly 250 alumni who've gone through this program and learned essential skills and hopefully built lifelong relationships for catalyzing businesses in the emergent and regenerative economy. So we encourage you to check out our course. You can go to lifteconomy.com/MBA. The next course, Cohort 7, starts on September 21st, 2021. So once again, go to www.lifteconomy.com/MBA. And now, on with the show. Welcome to Next Economy Now. The goal of this podcast series is to highlight the leaders who are taking a regenerative, bioregional, equitable, democratic, racially just, and whole systems approach to creating the new economy.
Andrea, welcome to the show.
Thank you for having me, Brian.
Andrea, tell us a little bit about how you first got into this idea of transforming finance. What were you doing maybe before you got into this financial side of the work?
It was, as might be the case for many of the people that end up working on regenerative finance systems, a bit of a side path. It wasn't a very straight trajectory. I was an activist since I was young, growing up in Italy. We get politicized pretty early. And eventually, when I came to the United States, I ended up going to law school and working in the space of corporate law and corporate finance on Wall Street. And while my two worlds there were colliding, I also realized quite emphatically that a lot of the decisions that were made in the corridors of finance were really the decisions that affected the issues about which I was particularly passionate as an activist. And in fact, there were very few things that were not touched by finance within the world of social change that I cared about. I didn't get to do much of that concretely while I was on Wall Street, but eventually after I left, I started looking more into the world of sustainable development as an alternative to the traditional capital flows north to south. And even that I found a little bit coming up short in terms of how it really distributed power, in terms of how it connected communities. And I was fortunate that I started working after that with an organization in Colombia that had for decades been working on indigenous self-determination in the Colombian Amazon, and was answering to pressures that indigenous leadership was feeling after many years of rejecting projects around oil and gas, mining, and extractive industries in the Amazon in general. They were now facing this wave of more, in a sense, environmentally friendly, socially positive projects around payment for ecosystem services, carbon credits, and the like. And the issue arose within the indigenous leadership that, frankly, while these sounded a little bit better, in many ways they still reflected the same dynamics as when the interest in the Amazon was around gold or it was around rubber. And ultimately, the communities with which Gaia Amazonas worked at the time ended up rejecting all of these RED Plus, payment for ecosystem services projects, which left me with this interesting quandary of saying, well, it's okay in this case that they got rejected. However, isn't it an unfortunate missed opportunity if even when investors are trying to do something good, they're not taking into account the role of communities and this broader power dynamics more fully and more at the center of their activity. As many know, Morgan Simon is my co-founder at Transform Finance. She and I were put in touch to discuss some of these issues, and we realized that there was enough there And it was still early enough within the world of social finance and impact investing that it might make sense to try to come up with some principles around it and try to really do an organizing effort with asset owners to help them understand how their capital could really be deployed in ways that were more consistent with the needs and aspirations of communities.
And so this is around 2013 when you started Transform Finance. Is that about right?
This process had been going on for a while. There was a lot of thinking that went into it before that in some ways goes back to Morgan's work over a decade ago with the Responsible Endowments Coalition. We did launch Transform Finance in 2013 at SOCAP, and we've been going strong ever since.
And so it sounds like Transform Finance was a bit of a organizing principle to a nascent movement. How does your work, say, differ from something like Confluence Philanthropy, or maybe give us an overview of Transform Finance? That'd be a good start. And then how does it differ, or what kind of value-added services do you guys provide from other organizations?
The two questions are definitely connected, Ryan, so I'll take them a little bit in turn. We did start with the idea of trying to foster a movement around this notion of transformative finance. We really thought of ourselves as being a network that included both asset owners, social justice practitioners, communities, and tried to be a bit of a way of bringing them all together. When we first issued the Transformative Finance Principles, this idea of deep community engagement in design, governance, and ownership, of non-extraction, so being thoughtful about the value that is being created versus the value that is being taken out of communities through investments, and the fair allocation of risks and returns between all stakeholders, so investors, communities, and entrepreneurs. We formulated these principles almost as an advocacy effort, really, and noticed right away that there were a lot of asset owners that responded positively to this, that felt like this was an opportunity for them to deepen their practice. So our work quickly shifted to saying, okay, how can we really empower this group of aligned asset owners and help them move their capital in a way that is consistent with these principles? This is a heavy lift, as you can imagine. So we started thinking, well, where are these deals? What would a real transformative investment opportunity look like? How do you know that it is transformative? How do you measure it? And who is it for? And what will the returns be like? So our work really grew on that asset owner side from being mainly focused around the advocacy and organizing to really providing concrete tools. And that became the Transform Finance Investor Network. So we thought that it would be a good idea to put together these asset owners that were facing some of the same issues. They might be, say, interested in affordable housing, but concerned about how that was going to affect gentrification and displacement in communities. Or they might be interested in fostering worker ownership, but trying to navigate how they could make investments into cooperatives, given some of the strictures around cooperative capital. And this community launched at the White House in 2014 with a commitment of over $500 million that was not organized by, say, a sector or a particular geography, but was really a commitment to say, we will move this capital in accordance with principles of social justice, with deep concern for how the communities are affected, and in accordance with the transformative finance principles that we mentioned above.
Maybe you could name the Transform Finance principles as well. That'd be helpful for folks.
Yeah, so the three principles that I mentioned before are deep engagement of the affected communities, not just in design, but also in governance and in ownership of the projects that affect them. So this idea of co-design by now is fairly common even within corporations. We think that if we're serious about wanting to positively impact the community, the voice and the agency of that community should be lifted up. And the ownership piece is equally important, really making sure that we provide some asset building opportunities within communities, especially in the context of the tremendous wealth disparity that we see. So a project that only creates wealth for investors clearly would not be quite as transformative as one that creates asset building opportunities for communities. That, of course, is related to this concept of non-extractiveness in finance that we take from the working world. And that is the idea that, again, if you're serious about about having positive social outcomes for communities, it makes sense that the bulk of the value that you're creating not be captured by the financial side, as might be the case in traditional finance, but be really for the benefit of the communities that you're working in. And the third principle, this idea of fairly allocating risks and returns between investors, entrepreneurs, and communities, is a response to the fact that a lot of the traditional financial actors that come into this space still have almost a muscle memory to try to push the risk onto an outside player and try to maximize the returns that they can get. And if we think in terms of the power dynamics in the world, there are some actors that are clearly better suited to bear risk of investments, and those by and large tend to be more on the investor side than on the community side. We saw this very much during some of the early efforts in microfinance that did not work out so well, where an investor that made a bad microfinance investment would still have a job and a roof over her head, whereas a community member that took on a loan with maybe some sort of collateral and something happened that affected that investment would end up in a much worse place than where she started from.
Great. So Andrea, how does your work dovetail with other similarly aligned organizations to help you further the work of impact investing? So just kind of trying to place how you guys work within the larger ecosystem of impact investing.
So it's clear that there is a lot of need for various organizations in this space that can organize different types of investors. Confluence Philanthropy, with whom we work closely, has been extremely effective in organizing many of the foundations around impact investing, as has done Mission Investors Exchange. Our efforts are focused on, I would say, two particular niches that are not fully covered by some of the other players in this space. One is this fundamental commitment to social justice as the lens and real transformative social change. So it's a move perhaps from palliative or progressively better ways of using finance toward really saying, well, let's use finance as a tool for social change in and of itself. So this is not a matter of saying, I want to do a little bit less bad or a little bit better, but it's to say, no, I really, in the ultimate arriving point, I would like for my capital to be seen as one of the many tools that I could use for social change. I can use advocacy, I can use political action, and if I happen to be a holder of capital, there is one more tool that I can use there. And this is also connected to our position that fundamentally a lot of these efforts should try to rise up the voices of the affected communities again. So we try to make sure that, let's say, the way quality jobs are defined does not just come out of JP Morgan Chase, but actually involves folks that have been on the front lines of worker rights and worker advocacy and have the lived experience of the worker perspective that can be brought in. The same could be said for efforts around racial justice in the United States, for example, or sustainable agriculture in sub-Saharan Africa. We always think that it's important for this work to really bridge the two worlds, the world of finance and the world of social justice, ideally in a way in which Transform Finance at some point could really step out of this conversation and there would be this seamless integration of social justice practitioners and investors.
I really love, the principles, and it's almost like you're working with large organizations, large foundations, high net worth funds, but you're doing activist style work, which I think is unique. The idea of projects designed, governed, and owned when feasible by communities, even that first principle, I'm not sure many impact investors even think on that level. And not to compare and contrast you to other impact investors, but more to say that I really appreciate the lens with which you're looking at these things. And maybe you could give us an example of what's something you've worked on that meets that first principle of designed, governed, and feasible, owned by communities.
So I would say first, Brian, to your point, yes, we are in an interesting in-between space, which is really where Transform Finance has flourished, where we're pulling on both sides. We might be a little bit uncomfortable in the finance space or uncomfortable for the finance space, but also we are ultimately working with capital, so we might be uncomfortable in some of the social justice space. And we're completely happy to try to hold that space and foster these new conversations. This means that in many cases it's a matter of meeting both sets of actors where they are and progressively trying to move them towards these aspirational principles. To give you a concrete example, there is a project that has been led by IDEX 1000 Currents that we've been involved in as an implementation partner. IDEX has done tremendous work for decades in trying to change the nature of philanthropy in the global north by lifting up best practices from the global south and really making sure that philanthropy does not end up being a neo-colonial effort. And in the wake of some early conversations around participatory grant making, this idea emerged of, well, what would it look like if we were to try to do participatory investing? What would it look like to have these community actors really at the table? And IDEX took this really bold leadership of saying, well, what if we set up a fund that is actually co-designed between the investors and the potential investees, which has a lot of intuitive appeal, but it's also radically different from how most investment funds are designed. And IDEX put together a group of asset owners that committed to being limited partners in this fund, even before knowing what the terms of the fund would be, precisely because those terms were going to be co-designed during an ongoing process with these potential investees. We spent 5 days together in Mexico City with the IDEX team, with the limited partners in this fund, and with the potential investees that came out of IDEX's cohort of grantees. Now, that's a pretty interesting way of giving not just a co-design, but also a governance and an ownership role to the affected communities.
I love that example. So some of the foundations and funds investors who helped pledge that $550 million initially, were they doing some of this work already, and then they could now be part of a community that's sort of looking at how do we spread this? And then are these foundations and funds and investors people who are already doing this work, or are you helping them get to the next level of consciousness and awareness about some of these topics?
It's a bit of both. So the founding members of the Transform Finance Investor Network were asset owners that had already done a lot of deep work around these issues, had already really thought about what it meant to them to invest their money in certain ways, that were deeply embedded in the social justice work. The idea was both to help them deepen their practice, because as asset owners, they might have either limited time or limited bandwidth to explore a lot of the issues that we have in some ways the leisure to explore, but also they might lack some of the deep connections with the social justice practitioner community that we hope to bring to the table. So our hope there was really to be an intermediary for these initial asset owners to say, okay, let's see how we can help you go deeper and deeper with your work. And frankly, I think that's a never-ending thing, right? We can always do better with our investments, especially in terms of, if we're thinking about it, in terms of power and wealth redistribution. The idea was also to have this initial group serve to activate others that were in the space and trying to figure out how they could deepen their practices. And as a cohort, really, as a community of practice, to try to bring in other players as well. So the network has grown quite a bit since its inception. Now the commitment is up to $1.3 billion, which seems like a big figure when you think of the association of social justice and investments, but it's also a drop in the bucket when you think of the overall financial flows in our economy.
I think that's where people get depressed a little bit. It's, I think, total assets under management. When I spoke with Fran Siegel, she was saying it's like 220 trillion just on stocks and bonds in the world. When you hear that number, looking at transform finance versus total assets under management, are you optimistic or pessimistic about our ability to make a difference in the world?
It depends a bit on the day. And today you happen to catch me on an optimistic day, I think. And there are a few reasons for that. First of all, I see that a lot of the folks that are getting into impact investing now are almost leapfrogging a lot of the early, tremendously important work that was done in socially responsible investing, in ESG investing, and are saying, no, but really, what can I do to deploy this capital in ways that are more transformative? So my sense is that there is an influx of capital that is seriously rethinking many of the underlying assumptions of the system of finance. Another reason why I am fairly optimistic about it is because I see a lot of interest on the part of social change agents to engage with finance now and to move beyond what used to be perhaps more of a confrontational dynamic with the world of finance, where rightly so, right? The experience of most communities, especially communities of color in the United States and communities in the global South, has not really benefited from the world of finance. So I'm optimistic by seeing now a willingness to say, look, we have to engage, regardless of what our specific issue might be, whether it's around disability rights or whether it's around women and girls in communities. It's becoming clear that finance affects all of these issues, and therefore it makes sense to engage. The work that we do on that engagement is really on two sides. One is on the opportunity to hold investors accountable, right, for communities to have their voice meaningfully heard in these conversations around the capital that affects them. And the other is really to become players in the world of finance, to really deploy the assets that they might have to start earn revenue projects, because it's clear that philanthropy by itself is not going to heal the world, especially not the amount of capital, of philanthropic capital that is flowing into social justice initiatives. There is one aspect about it which I feel a little bit less optimistic, and that goes, for better or worse, with the mainstreaming of impact investing. Much as I would love to see impact investing going mainstream, it seems to me like we're losing perhaps a tremendous opportunity to really fundamentally change the role that finance plays in society. And some versions of impact investing can really serve almost as an escape valve for a broken system, right? You're an asset owner, you feel somewhat uncomfortable with what's happening in the world of finance, and you see some versions of impact investing that say, oh, but you can do well and do good at the same time, and that sort of eases that pain that the financial system seems to express for a lot of people. And I would like to see a way for all of us to be able to capture that interest in really more drastically reforming the role that finance plays in society.
Maybe we should go down that rabbit hole a little bit and talk about that.
Happy to do so.
Yeah, because I think, especially with the election of Trump and, the potential for many catastrophic things. One of the silver linings one of my business partner has held is that the current economic system almost needs to fail in order for there to be massive change to the structure of the system. We've also discussed things like, is the money itself and the way that you have to create debt in order to have money. So there's these sort of layered conversations. And I'm just curious, what do you see as that major, what's the sort of scary but major financial transformation that you see needing to happen?
This is a very, very interesting topic to try to go into. In part because I think that there is a philosophical layer to it, and then there's the practice or the practical element of who benefits and who suffers in today's economy. So while I might agree that it would make sense to have a complete reset of the economy, say, hey, let this whole thing crumble, and then we'll start up with a new system. The brunt of that would be borne by the people that are in least favorable a position to do so. And you see that even with the failure of specific companies, right? The CEO of Enron is still doing relatively well compared to a lot of the people that were affected by the work of Enron. The same for the former CEO of Lehman Brothers. So letting certain things fail might systemically have a certain role in resetting the system, but I'm afraid of who would be bearing that cost. What I think we can do instead of that drastic approach is to have a combination of both limiting the bad within the context that we are operating in, right? We have a pretty well-set economic system and certainly a well-set financial system, trying to lift up and push for the best practices within that system, and at the same time, trying to come up with new alternatives that are out there. And we see a lot of those in some of the community efforts around financial cooperatives of cooperatives, that would say, okay, what would it look like if we really took this work into our own hands and we created a parallel or a complementary financial system that would really work for us. A lot of the place-based impact investing efforts, for example, would go in that direction. There are some that the Solidago Foundation has been leading that really try to give this major governance role to community stakeholders. It's still within the context of finance, right? We're still talking about capital that is moving around, but the approach behind it is dramatically different. So I don't think we can afford the luxury to wait for the financial system to fail before there is some dramatic intervention. My personal position is that we need to work both within the current financial system and start fostering some of the alternatives that can come in and eventually replace it.
It's a little bit like, as I know you're familiar with the Bali community, Deborah Fries from Berkana Institute, her idea of the both working on the existing, hospicing out the old system and birthing the new system. It sounds like that's some of the that's kind of where you sit, as there needs to be both.
That's right. Yeah, I think of it in the dorky terms of the philosopher Otto von Neurath that was saying, we are like a ship that we need to rebuild while we are sailing it. So we know that we want to end up with a completely different ship, but this is the one that we're on at the moment, and we need to fix it while we build a new one.
I think what has emerged, at least for me and the B Corp community, is this idea of business can really be a solution, because you traditionally had foundations and nonprofits and government trying to do things at least relatively well, and you had business sort of like trashing everything and sort of externalizing all costs for shareholders. But it seems like the silver lining, maybe you could speak to this in your work. Do you see business as being a primary solution to some of these challenges, or do you still see businesses having too many inherent conflicts? And I'm just kind of curious on your position as to like how business can be that role, that savior.
I am not so positive about business being the solution, and this is because of some perhaps deeper issues with how business has grown to be. So while I think that business can be a solution in terms of taking care of specific problems around the world, I think that business as currently devised, even within the context of world positive businesses, oftentimes it misses the bigger mark, as my colleague Andrea Ben-Ami puts it, to really redefine who is going to benefit from the economy in general. So if, say, you are facing the water crisis in Bangladesh, right? There is no access to clean water. The government is not providing it. Philanthropy is not really in a position to step in and take care of it. You could indeed make the lives of Bangladeshi rural communities better by having a market-driven, business-driven mechanism for the provision of clean water. However, I would like that to be coupled with a degree of attention towards what does it mean, for example, to privatize some of these resources. So if you're getting cleaner water all of a sudden, but the sources are now owned by even a private social enterprise, you have a little bit of disconnect there between the solution to that small problem, so to speak, or that very big problem of access to clean water, and the broader issue of who gets to call the shots in society. I think that unless we are addressing both things, we do end up with this odd privatization of problems. And if we combine that with the earlier point about doing well while doing good, or still beating the market through impact investing, which is one of the positions that you see now in this field, you could easily end up in a space where two things happen. First of all, those that are investors that are beating the market by solving social problems are still becoming richer and richer. And those whose problems are solved have no additional agency being created for them, right? So if I invest $10 million at 10% into solving that crisis, and the person on the ground goes from having $2 a day to $3 a day, yeah, their life might be a little bit better. It might make a big difference for them. But I've gone from 100 million, from 10 million to 11 million, let's say, right? So am I really systemically making the world a more equal place? Is this a play that is going to close the big gap that there is between those that have and those that do not have? That is the first issue that I see with business as an approach without this broader kind of set of considerations around it. The second issue that I see is with accountability of private businesses and accountability of private investors. So if we have, say, some of the foundations or some of the new LLC type of constructs that are sprouting up in the Bay Area, I applaud the fact that they would be directing their capital towards some of the big issues in the world. However, I don't see a clear chain of accountability there. First of all, right? They might say, oh, I want to invest $500 million in Malawi. Why Malawi? I decided I wanted to invest in Malawi. If it doesn't go well, oops, I leave Malawi. And there is really no accountability to that, right? Again, going back to that issue of who gets to bear the risk, it could be that Malawi is in a worse position than it was before. And we have seen that with some of the interventions in the Newark school system, for example. There was an accountability that at some point was there even when, say, some of the multilateral institutions and entities like USAID were, for better or worse, in charge of a lot of these capital flows. At least there was a political dynamic around it. And from the more political perspective, perhaps, I am very concerned about it being the biggest asset owners that get to make this kind of decisions. Even if all their projects are fantastically good and a lot of people in the world are doing better, I still am uncomfortable about the fact that it was built on that prerogative, it was built on that privilege that they were able to make these interventions without necessarily coupling it with sharing that privilege and sharing that power. And that seems to me like a perpetuation of the idea that those who are wealthiest get to call all the shots. I really like the investors that are out there that say, yes, I will use my power, I will use my wealth. I'm not just going to burn it because money is evil. No, money is necessary in the world. I can use it in a way that props up powers for those that have not had it so far, as opposed to perpetuating my own particular ability to make decisions.
That's really great analysis. You're one of the only people I've spoken to who really gets the I really love this question of who benefits ultimately, because I think the recent trend, like you alluded to in impact investing, is, hey, if you want to do good, put your money in companies that have a social environmental mission, and then when they scale or go public, you'll be benefiting society because it'll be a healthy product or something. And I don't think the sort of the cutting edge realization that you pointed to is, if I'm a wealthy white male who invests $100 million in this startup, and then because this, this consumer packaged good tea company went public, I made $500 million more dollars. I'm actually increasing wealth inequality, even though I'm theoretically helping with a tea product instead of maybe ExxonMobil or something. So I think there's this really interesting movement now around, and it's one thing we're trying to balance at Lift Economy, is instead of having companies exit and have this high growth mission VC, this kind of like movement, it's how do we actually have the capital stay within those communities? So worker ownership or, I think, but many companies don't think, oh, I should sell my company to my employees to keep the wealth local. It's constantly thinking about like, what's the exit? So it's sort of like the expectations of capital are also driving this. I wonder if you could speak at all to that in your work.
Yes, I can try to unpack that a little bit, starting from the point that perhaps needs to be clarified, that we're not against returns and we're not against profits, right? If these enterprises and if these funds are not profitable, then we would have no impact. It would all fall apart. The idea is really that as you scale these enterprises, as you scale these funds, you should also be mindful to scale the impact that they have, and you should always keep an eye again on who is benefiting from this. And that was something that came out of the analysis of early variations on fair trade, right, where you would look at the farmers getting 5 cents on of the fair trade premium per pound. But up the chain, there were a lot of other actors that were really capturing most of that fair trade premium that ultimately you and I pay at the supermarket. So saying, okay, is that really the best that we can do, or can we look at one level beyond it? So oftentimes you do need to have those profits. And if we want a lot more players in the space, we need to be mindful of the issue of profits, right? Because again, there might be asset owners that, thanks to their position and their privilege, can afford to, just go for a capital preservation type of return. However, you have pension funds, for example, that will need to make a meaningful, healthy return so that they can pay out those pensions. Or as there are more crowdfunding efforts, we're mindful of the fact that many of the people within communities that are investing in this way actually do need some sort of a return. So it's not really an analysis around the returns to investors per se. Is really around, well, how much of the value that is being created is being shared, how much of it is being accumulated. Is this more akin to rent seeking than investing, really? Because I still like the old school idea of investing, from the 15th and 16th century, of saying, no, I'm putting this money at risk because I want to see something happen in the real economy, not just because I want this capital to perpetuate itself, which leads to the financialization of the whole system. A related point that you bring up, Brian, is around the dominance that venture capital as a model has had in the collective imaginary around impact investing. And today there was something from Steve Case on the role of venture capital in rural communities in the United States. Our sense is that venture capital can play a role. There are some entities that are perfectly suited to take on venture capital money. However, for a lot of the social enterprises that might not scale fast enough, might not scale big enough, or might not even want to scale, or might be concerned about preserving their mission, really venture capital is just not the right capital tool, right? It's just one out of many alternatives. So we've been doing a lot of work, most recently with the Inter-American Development Bank, on structured exits, both on the alternative deal structure and on the alternative fund structure, because we just need more variety. Some things will be better suited by some sort of variable payment obligation debt type of investment. Others might be better suited by an equity redemption as the exit. So you don't have the pressure to grow, you don't have the pressure to sell or to IPO a certain number of years down the line, because that's really the dog, the tail wagging the dog, right? Where it's the pressures from the investment side that determine the fate of the real economy entity. So there is a lot of work still to be done there in terms of seeing how we can combine the just amount of profits with a high level of impact with the right investment structures that are consistent with both.
Yeah, that's a great clarification. And clearly glad to have you in this space, because I think the nuance there is very informative. Because I think many folks see it as, there's venture capital, there's debt. They don't really know the difference between how impact investing aligns. And I wish we had another half hour, because I want to talk to you all about these alternative exits. Yeah.
Can I add one thing?
Yeah, go for it.
So another important issue to think of when we think of this equivalence between impact investing and venture capital is that really it's a small amount of assets that is flowing directly into enterprises or even into venture capital funds or even at the private equity level, if you compare it to all the asset classes that even the fiercest impact investors hold. There is public equities, and there's a lot of impact that can be done there. There is fixed income. There is a lot of impact that can be had there, certainly within real assets. The issue there is that it's a little bit less clear. It takes a few more steps to realize where the real impact can be in public equities, for example, or where it can be in fixed income. We've been looking recently at the way that municipalities are funded in the United States. How many of the municipalities that have had problems of police brutality are actually largely funded by fines and incarceration. Almost half of their revenue is coming from that or from civil asset forfeiture. So what can be done within a muni bond allocation, for example, to ease some of those problems? Or on the public equity side, as we look at issues of racial justice, which is another big project that we undertook earlier this year, you might look at, for example, representation on the board of a public company by women and people of color. And then you turn around and you say, well, actually, if we're looking at this as a systemic issue, that is very, very important, and it will actually influence a lot of the practices of these companies. But slightly more esoteric issues such as tax avoidance practices, for example, or excessive share buybacks are actually decapitalizing communities of color at a higher rate than they are affecting predominantly white privileged communities. So there's a lot of impact, so to speak, that can be had across the board, really, and just playing with the instrument of venture capital or venture capital plus private equity is really limiting a little bit the wider scope that we can have for the impact that we want to see.
I love this conversation. And maybe for folks who are interested, maybe we could speak a little bit. What are some of the resources? Do you have particular white papers or maybe directing folks to the website where they can learn more about Transform Finance?
Yes, absolutely. We have some resources that are publicly available on our website, transformfinance.org. We have other resources that are available to members of our investor network. And I would encourage anybody who is interested in learning more about these issues to contact us and to explore membership in our investor network. And I would also encourage people that really want to dig deeply into these issues to keep an eye out for the forthcoming publication of Morgan Simon's book, Real Impact, that is coming out from the Nation Press in the fall. And I've had the privilege of reading that book in advance, and I think it really does a tremendous job of unpacking some of these issues and showing both the theoretical and the ethical work that is going into this, as well as the very practical ways in which asset owners, regardless of whether they have $100 in the bank that they want to move to a more socially conscious bank, or they oversee a $100 million portfolio for a foundation, can the steps they can take in order to start moving money in ways that produces real impact.
Fantastic. And maybe the last thing here is, are there any other requests of the listeners? One of the things we like to do is say, how can our listeners support your work? So it sounds like getting the book by Morgan Simon, Real Impact, coming out this fall. Any other requests to the audience to help support Transform Finance?
Well, as a field-building organization, we think that the best way in which people can support our work is really to engage with many of these issues and take a hard look at how they are conceiving of impact, and always asking, well, is there a way in which I can deepen the practice? And we're always welcoming that sort of interactions with all sorts of investors, but also with entrepreneurs, with community leaders. Of course, as a nonprofit organization in this space, we're always welcoming any kind of other support, whether it's in kind or engaging with us in a volunteering capacity or making introductions for us to other people in this space that might be interested in pursuing a conversation about how to transform finance and how to make finance more transformative.
Next Economy Now is a production of Lift Economy. To listen to all of our episodes, go to lifteconomy.com/podcast. That's LIFT economy.com/podcast. You can also sign up for our monthly newsletter at lifteconomy.com/newsletter. Please also rate and review our podcast on iTunes, Spotify, Stitcher, or wherever you get your podcasts. Thanks for listening.